Very good evening to all of you. So we are back for the next section of this income tax law paper. So we have been discussing salaries all along. We had just said we ended the last session with the concept of relief under Section 89, and there is a problem there. So I just told you that in case if you're solving the problem, probably you will understand the relief better. So apart from that, to just give a heads up on salaries chapter, we discussed about section 15, which talks about chargeability, that the salary is taxable on due or receipt basis, whichever is earlier. And then we discussed about 17. There are three clauses. One is wages, another is perquisites, and then profits in lieu of salary. In this salaries thing, that is wages, we discussed about wages, salaries, allowance, and bonus. We discussed about various allowances where some are completely exempt, that is 100% exempt, where some are fully partially taxable. So this is what we discussed about various allowances. And then we also discussed about perquisites. How do we value perquisites? When is it taxable in the hands of specified employee? When is it taxable in case of all employees? So we discussed about that perquisites also. And we also discussed about profits in lieu of salary, where things like your retrenchment compensation, voluntary retirement scheme, all this are part of your profits in lieu of salary. Then we discussed about section 16, which is deductions. We discussed about standard deduction, entertainment allowance, and professional taxes. So this is what we discussed overall about salaries, right? So hope you have a complete understanding of what salary is about. There are some questions, so probably we wanted to understand by Ayush says, why was standard deduction was not part of the calculation in the illustration that we worked on? When we are actually working out Zagir's problem, we did not discuss about section 16. So since not to confuse you about a topic which was not discussed at that point in time, I did not take through the standard deduction. But yes, since the question was about gross total income, standard deduction must be deducted. But at that point in time, at that slide, we had actually not covered standard deduction. That's why I said, let's not bring it right now. Let's have it later point in time we were actually discussing. Right now, we all know what standard deduction is. It is 50,000 or the salary, whichever is lower. Now, if you're reworking this Zagir's problem right now, you can include standard deduction because right now you know what standard deduction is. So it was purely because it was not covered at that point in time. And Akash Neil has a question on wear and tear. So it is basically wear and tear is for the calculated year, that is completed year. So it is for each completed year. So it's not financial year. If an asset has been purchased has been provided for use in January 21, depreciation has to be calculated from January 21 to January 22. So it's exactly for one completed year. So it is only for the completed year. So if there is one in between year, it's not taken. So the provision says 10% wear and tear for completed years for each calculated year. So it is only for the whole year for which it is actually got completed. So that's how you do it. You are actually calculating the wear and tear. In case of transfer, okay, so there are two things, right? We are talking about usage, wear and tear. In case usage and transfer of asset, that is sale of asset. When it is sale of asset, what you need to do is you need to calculate from the day the asset was purchased. It has nothing to do with usage. See, let's take, I am actually using a laptop. So this laptop was given to me in 2021. But this laptop was actually purchased in, let's say, 2019. For the purpose of calculation of this transfer of, that is the sale of asset, you'll have to calculate wear and tear from the period in which it was purchased by the company, not in which it was provided to use. So Akash Neil, what we are saying is wear and tear should be calculated for the completed year. In case of transfer, it has to be calculated from the year in which it is actually purchased, not when it was used by the assessee, because we are calculating the WDV at the time of transfer. So that's what we are doing. So we'll have to only calculate it for the completed year, and it has to be calculated from the date of purchase, not from the date of use of the assessee, because we are talking about sale. So when you say sale minus cost, that is purchase cost, is your gain or loss, correct? So it has to be the cost from the time of purchase. So that's what it is about, correct? And Rafik Boy Mayman, Mayman, so basically you wanted to understand sweat equity share. As I told you, please remember the word sweat. You know what sweat is, and that too in the scorching heat, right? In most of the places across India, wherever we go out, we know what sweat is. Now let's take this word sweat into employment. So what does it mean? I'm doing more work, okay? I'm doing a lot of work. Because of this lot of work, I'm sweating. So the one who sweats more does more work. That's an assumption, right? So now for that extra effort, for that extra sweat, you are allotted equity shares. For that extra sweat, you are allotted equity shares. Now in this equity shares, let's say it is being allotted to you. The market value on that date of the equity share might be something, right? So in the example we discussed, it was around 300 or something, okay? So now a 300 rupees worth share, a 300 rupees worth share might be given to the employee either free, completely free, or at concession. The company will say, you need not pay me 300. I know the market value of the share is 300, but why don't you pay me 200, right? 200. Now, I have actually paid 200. So generally on any perquisite, in valuation of perquisite, what did we say? We take the value, okay, the cost, minus what is recovered from the employee. What is recovered from the employee? So what is the cost here? It is 300 rupees. The market value is 300. So 300 minus how much is recovered? 200. So 100 rupees per share will be automatically treated as your perquisites. So that is what will be the perquisite of this. So sweat equity shares or equity shares allotted to the employee of the company at a concessional rate. So that difference between the actual rate, that is the fair market value, and the concessional rate, so which means what is recovered from the employee, this difference is actually called as valuation of perquisite. Hope you have understood, Mayman. And what is the weightage of salary chapter? See, probably we'll take it this way, okay? I actually wanted to tell you this also. It's basically 60 marks belong to your direct tax. Now, in the 60 mark of your direct tax, 18 mark is going to be MCQ. 18 marks is going to be MCQ. Probably I'll write it out so that you have a better understanding. So 60 mark is your direct tax, where you have MCQ of how much? 18, correct? Out of 30 mark, 18 is going to be from direct tax. And then other questions is going to be 42, correct? In this 60 mark, as a whole, the weightage as far as ICA is given, they have given it for the heads of income as a whole. Heads of income as a whole. Now this heads of income includes salary, house property, capital gain, business or profession, other sources. But for at your level, that is intermediate level, what is more important is the chapter salaries. So typically if the institute says that the heads of income has around 25% weightage, let's say in that 25%, at least 50 to 60% will be from salaries. So if you ask me, salaries alone will at least contribute somewhere around 15 marks out of the 60 marks. So at least 1/5 will be from the salaries chapters around. So whatever proportion institute has given for the salaries chapter is not only for salaries, it is heads of income. But if you take salaries alone, if you ask me, it should be at least 15 marks. Mantanjali, right? And I guess I've pronounced your name rightly. If not, I'm sorry. So yeah, sweat shares are those issued to employees and directors of the company. Illustration 25, what exactly is that? I have a problem on relief, so I'm not sure about the relief number. So probably we'll step in. I guess it is about... okay, no. So I'm not actually going to solve about illustration 25. Maybe you can just ask me the question. If you have something on that illustration 25, I can answer you. Because we did... yeah, right. Illustration 25 is what we are going to solve right now. So this is illustration 25. I've just not given the number. So this is illustration 25. So yes, we are going to solve. So probably if you have doubts after solving, you can check with me again, Poonam. So for time being, we'll start with the concept related to illustration 25. So now and then, probably I guess I give you some shortcuts or tricks to remember how the provisions can be remembered, how exactly it can be remembered. So that probably I do that, some shortcuts. But if you ask me how to remember all the provisions or something of that kind, you must link the provisions. Probably you'll have to compare with one provision or the other. For example, if it's allowance, you'll have to compare one allowance with the other and try to remember it. Probably you can create your own number theories. For example, with respect to this car perquisite, we spoke about for 1600 cc. If the car is owned by employee, it is spent by the employee. If the expenditures are spent by the employee, we said leave out the 1000, keep the 600. So it is 600 rupees per month, correct? And if it is going to be more than 1600 cc, we said turn 6 upside down, it becomes 900. So typically, there is no hard and fast rule as to say this is the right way of remembering, this is not the right way of remembering. But one common way of remembering is you first believe in yourself, thinking that you are capable of remembering the provision. That capacity of saying that I am capable to remember the provisions will itself help you find ways to remember the provision. And of course, now and then I will always tell you some shortcuts as to how you can remember this. The provision. In fact, in this house property, we'll have various things where we can remember also. So typically, what my suggestion is, first start believing that you're capable of remembering the provisions. To actually remember the provisions, you can compare and create theories, create stories about the provisions so that you remember it. So yeah, we'll get on to the provision. So basically, a relief under section 89. So we were talking about relief in several cases. So relief can be due to three reasons. So the first one is basically when there is arrear or advance salary. So relief can be because it is because of arrears or advance salary. So that's one possible scenario. The other thing is it is arrears only, but this time it is not because of salary, it is because of family pension. So there is also possibility that you can claim relief. But this chapter is about salary. So typically you understand what happens in case of salaries alone. And similarly, the last case is when VRS, no relief on VRS, that is voluntary retirement scheme. So when there is no relief on this voluntary retirement scheme or termination, in that case, what happens is relief under section 89 will be provided. So this is what relief is. So what exactly is this relief? Relief word is a very simple word, right? A normal English term. What do you understand by the term relief? You are relieved of something, correct? You are relieved of something. So here in income tax, what can be relieved of? You can be relieved of some tax, correct? You can be relieved of some tax portion. So that's what we are talking about relief. So we'll understand this a little more detailed through this illustration. Before reading out this illustration, I'll tell you one more concept something which I've already told. When I talk about this relief, what did I say? The current taxes are higher than the taxes if it had been paid in the related year itself. For example, if it is an income of financial year 15-16, had you paid tax in that financial year 15-16, it would have been lower. It would have been lower than the taxes in financial year 21-22. For that scenario, you take relief. So let me repeat. What did I say right now? Let's take example of financial year 15-16. So in financial year 15-16, I am saying my tax would have been 100 rupees. Now, in financial year 21-22, I am saying my tax is 120 rupees. So what is the relief here? What is the relief? Is it difficult? Should I answer you this question? Hope everyone here would actually know the answer. So what would be the relief? Had he paid in 15-16, he would have only paid 100. But in 21-22, he is paying 120 rupees. So what will be the relief? What will be the relief? 20, correct? So 120 minus 100, because I've paid extra taxes for this year, but it is not this year's income, it is some other year's income. So if that has been included in that year, my tax would have been this much only. So now can we step into this illustration 25 and start understanding this particular problem and the concept of relief? Sorry. So it's about a person, Mr. Hari. He has turned 46 years. So he has turned 46 years on 28 March 2022. So what did I tell when you're reading a question? You should see whether each word is relevant for the question or not relevant for solving the problem. So certain words are critical for solving a problem. Certain words are not critical. It is just probably to confuse you as per that example. So now, probably the age could be because to understand whether this person is a senior citizen or not. So otherwise, this 46 years has no relevance. On 28 March 2022. So that's what it is about. Now you are informed that salary for the previous year 21-22 salary, which means probably we can assume that it is a calculated salary. So 10,20,000 is a calculated salary. But in that year, not just 10,20,000, the employee is, that is Mr. Hari, is also receiving rupees 3.45 lakhs. What is this 3.45 lakhs? It is arrears of salary. It is arrears of salary. So now, generally, it is taxable. Salary is taxable on what basis? What basis? I just summarized right now, section 15. What is the basis? Due or receipt, whichever is earlier. But in some cases, in case of arrear salary, though it is actually due in that year, they could not have been received in that year. So what example we did, we said, let's say this financial year 15-16 is because of this pay commission. If you want me to explain you what pay commission is, this pay commission is basically, let's say a team of authorities who decides on revision of salary payments. So let's say they have appointed this commission in 15-16. This commission works on various aspects, and finally after 3-4 years, they tell you this should be the salary revision. So when they're actually giving the salary, they will give it for last 4-5 years put together in one single year. So that is what is actually called as arrears of salary. So now in that year, you don't know how much your revision is going to be. So you don't know what is your due is. So it is taxable on receipt. So it is taxable on receipt basis. So though due becomes first, receipt is later, it is still taxable on receipt basis because you are not able to understand the concept, that is how much is actually due. You do not know at that point in time. Clear? So that's a concept. So now that's what he is receiving as arrears of salary. So further, you are given the following details relating to the earlier. For that 3,45,000, they are giving this breakup. So for 10-11, it is 1,03,000. For 11-12, it is previous year. 11-12, it is 1,17,000. For previous year 12-13, it is 1,25,000. So that's the period for which he has actually received. So 220, 345, right? 3,45,000 is what is received. They are also giving you, the question is also giving you what is Hari's actual salary income in that year. They have given for all these 3 years. So what does this mean? This means that column, taxable column, does not include this arrear salary. So you know what was actually taxed in that year, what is actually the proportion of arrears relating to that year. Now they want us to compute this relief under section 89 for assessment year 22-23. Assume Hari did not opt for section 115 BAC. You all know what 115 BAC is. It is an optional salary tax rate. So now, most likely, question will actually tell you whether you must opt 115 BAC or not. Okay, that is clear. But if the question does not provide, you can have two options. For example, if the question has tax liability, that is, you need to compute tax liability. Okay, you need to compute tax liability, and question is silent on whether 115 BAC is applicable or not. In this case, you should assume 115 BAC is opted. That is, which means you should compare to see whether 115 BAC can be opted or not. But the question is only on computation. That is, let's say, particular head of income, some head of income. then you can assume no 115 BAC. Only if the question is silent. Of course, if the question provides you, you don't have an option. The question is silent. If it is relating to tax liability, you must assume that 115 BAC is also applicable. Else, you can say that 115 BAC was not assumed, because the 115 BAC primarily plays a role when you will need to calculate tax liability. So that's where it becomes very important. In other cases, it only matters whether a particular allowance or a provision is allowed or not allowed 115 BAC. So typically, depending upon the situation, you need to decide. But most likely, question will probably tell you whether 115 BAC is applicable. It should be opted or not opted. So in this case, it very clearly says Hari did not opt section 115 BAC, not. Correct. So now they've also given you the slab rate for 115 BAC, and also have given you what is the education cess in those 3 years. So what is the rate in 10-11, what is the rate in 11-12 and 12-13 previous year. So in 10-11, up to 2.4 lakhs, there is nil tax. But in 11-12, up to 2.5 lakhs, there is no tax. So that's the only difference. Otherwise, the entire rate is same. And they have also given the education cess and higher education cess. Currently, it is 4%. Previously, it was only 3%. You see that? So there is extra 1% cess you are paying. Correct? So that's an extra tax. So relief is typically for things where you are paying extra taxes in the current year. So can we work out this right now? So what is the concept we said? We said that as far as the concept goes, we said current tax greater than old tax. So only then we said relief is applicable. Now, when you say current tax, right? Current tax include current year income plus arrears. Correct? So now current tax includes current year income plus arrears. So you know how much extra for arrears. Correct? How much extra are you paying because you had arrears? So that's the first concept. As far as old tax concerned, paid is for the income without arrears. Now let's say estimated. What is estimated? Estimated is if they have included this arrear also, what would be the tax? So it is estimated with arrears. The paid is without arrears. So this is like without arrear. This is like with arrear. Without arrear, with arrear. Now this is in this also you calculate how much is estimated excess. You have actually not paid excess, correct? Estimated excess. So now, if this extra is greater than this estimated, that difference is relief. Clear? So in the current tax, I identify how much extra I am paying because of arrears. In the old tax, I am trying to understand how much excess I would have paid if I had included arrears. So estimated excess. So this excess of current year minus estimated excess of yearly arrears. This difference, if it is in positive, it becomes 0. So now can we start with the current year? Because this is step 1, correct? So now step 1, step 2. To identify this, you need to calculate every time. You need to calculate with arrear, without arrear. Now let's start with arrear. So computation of tax for assessment year 2022-23. Okay, so we're going to calculate that. What we'll do is we'll just say particulars. So with arrear, without arrear. Okay, so that's what you're going to actually understand. Now the first thing is what? Tax. Correct? So tax on how much? So it is 10,20,000 and 3,45,000. So with arrears, it is 14,65,000. So let's say tax on income. Okay, this is 14,65,000, and without arrear, it is 10,20,000, right? It is 10 lakh 20,000. So this is what you need to calculate. Now for this, you need to calculate your tax rate. So how do you calculate? Now tax on income. So you are actually calculating your income tax. Income tax. Now this income tax will differ for each of them because the income itself is different. For 13 lakh, that is for the first to 2.5, 2.5 to 5, 5 to 10, how do you call? Okay, greater than 10. Okay. So now for this, it is 0. And then you have what? 12,500. Then you have 1 lakh. Correct. More than 10 lakhs. More than 10 lakhs. In the first case, it is um, first case it is 1020 plus 3 lakh 45,000. Okay, I'm sorry. So it is 16. So it is 1365. So for this 3,65,000, I need to calculate 30%. Let me calculate 3,65,000 into 30%. So it is 1,09,500. So how much is it? 112,500 to 22, right? 1,013, 22, 222. So this is with this case. What if without the 0? 12,500, 1 lakh. Here it is only 20,000. So for 20,000, it is 30,000. 30%. So it is 6,000. So what becomes the rate? The rate becomes 1,12,500, 1,18,500. Correct? So here it is going to be 2,22,000. Here it is going to be 1,18,000. So that is 12,500, 112, 118,500. We are talking about 20,000, right? Okay, so it is 1,18,500. Correct? So that's 118,500. Now you need to add cess. Add cess. So what is the cess? 4%. That is 2,22,000 into 4%. So it is 8,880. Sorry, I guess it's wrong. 2,20,000 into 4%. It's 8,800. 2,20,000 into 4%. It's 8,800. Here it is 1,18,500 into 4%. So it is 4,740. Correct? So that's what it is. Okay. So now what happens? Your total becomes 230,800. Here it becomes 123,240. Just check whether the additions are correct because I'm just doing it on my own. 230,800 and 123,240. Correct? Yeah. So that's it. Now we also have to calculate for rest of the years. We can say computation for previous periods. Previous period. So what do? You take particulars for every year. Okay. For every year, let's say you need to identify taxable income. Then you take income tax, add cess, and then you calculate tax. Correct? So we are talking about 3 years. That is 10, 11, 11, 12, and 12, 13. So for all these 3 years, you take, let's take 2010, 11. You take with arrear, without arrear. Correct? So we'll write it as with arrear, without arrear. Now 2011-12 with arrear, without arrear. Last year is 2012-13 with arrear, without arrear. Correct? So this is the total thing that we are going to calculate. So this is what we are going to do it for all the 3 years. Now for all the 3 years, what are we saying? We are saying it is 7,10,000, 825, 950. So we are saying without arrear, 7,10,000, sorry, 825, 950. I'll just mark another thing here. Okay. So now we are saying it is 7,10,000, 7,10,000, and then we are saying 8,950, and then you have 9,50,000. Correct. So these are the things, and then what is the arrear? Arrear amount is 1,03,000, 117,000, 125. So 1,03,000 will make it 8,13,000, and 1,17,000 will make it as 9,42,000. Correct. 825 plus 117 is 942, and 950 plus 125, that is 1075. 1075, correct. So these are the three numbers. So what you have, 813, that is 813, 942, 1075, correct. So these are the three incomes. So now we have done it. We need to know the tax rates. We said in the assessment year, that is financial year 10-11, that is previous year 10-11, up to 2.4 lakhs, no tax. From 2.4 lakhs, it says it is 10%. It is from 2.4 to 5 lakhs, it is 10%. On 5 to 10 lakhs, it says 20%, correct? So now what do you do? You'll have to calculate the for the balance period. So that is, what if it is 8,13,000, correct? So now in this 8,13,000, it will be like how much? 0 to 2.4, 2.4 to 5, 5 to 10, greater than 10, correct? I'll just draw this for better understanding. Correct. So now 0 to 2.4, it is nil, correct, in both cases. So for 2.4 to 5 lakhs, 2.4 to 5 lakhs, in fact, when you're actually calculating here and all, it is 2.5 lakhs. So let's assume this 2.4 is 2.5 for other cases. So this just for working purpose, I'm doing it here. So now for previous year 10-11, we are saying it is for till 2.4, it is 0. From 2.4 to 5 lakhs, that is for 2,60,000, it is 10%. It is 10%. So you take 26,000 in both cases. 5 to 10 lakhs, that is for this period, it is 3,13,000. So 3,13,000 into 20%. So it is 62,600. Correct. So we are talking about 3,13,000. That is 8,13,000 minus 5 lakhs. So that's 3,13,000. Now 7,10,000. So when you say 7,10,000, the balance is how much? 7,10,000 minus 5 lakhs. So it is 2,10,000. So it is 42,000. Here it is nil. So what becomes? It becomes 88,600, 68,000. Correct. So you take 88,600, 68,000. On that you take 3%. So on that you multiply 3%. How much is it? 1,260. For 88,600, I'm sorry, I think I've calculated 68,000, right? 68,000 into 3 percentage, 2040, 2040. And then for 88,600 into 3 percentage. Remember, the cess is only 3 percentage, not 4 percentage as we are doing right now. So it is 2658. So it becomes what? 90,258. Here it becomes 70,040. Correct? 70,040. So this is what we are doing it for 10, 11. Now for 11, 12, of course it is 0 for the first 2.5 lakhs. So from 2.5 to 5 lakhs, it is 10 percentage. So for 2.4 to 2.5 to 5 lakhs, that is for 2.5 lakhs, 10% is 25,000. So in both cases, it is 25,000. So here it is 9,42,000. So which means 4,42,000. For 4,42,000, you calculate 20 percentage. 4,42,000 into 20 percentage. How did I get 4,42,000? It is 9,42,000 minus 5 lakhs. So now in this, I'm calculating 88,400. This is nil. So here it becomes how much? 108, 113. 113,400. And here it is 8,25,000. So we'll have to do 3,25,000. 3,25,000 into what percentage? 20 percentage. So it becomes 65,000. So in total it becomes 90,000. So 113,400 and 90,000. On this you calculate what? Calculate what? Education says 113,400. If you're doing it step by step, see how easy it is. You don't make any mistakes if you're doing it step by step. 3,402. We are only taking one step at a time. We are not thinking at the answer. We are not thinking about anything. We are only taking one step at a time. So what is 90,000 into 3%? That's a step, correct? 90,000 into 3%. So what it is? It is 2,700. So it becomes what? 92,700. Here it becomes 116,802. Correct? So that's what it is about. 116,802. So that's what you're actually getting it. So that is for assessment day 10, 11, 8, 13, 7, 10. You have calculated. And now, whatever we are actually doing it, we have to calculate it for the next period. That is, what about this particular assessment date 12, 13? For 12, 13 also, the rates are exactly the same. So there is no difference in the rates. So that's why you are actually calculating it in the typical, whatever is actually applicable, you are calculating it. So now what do? You actually take 10,75,000. So for 10,75,000, for the first 2.5 lakhs, it is actually 0. For the next 2.5 lakhs, it is 25,000. 25,000. The balance, that is for here, it is 10,75,000. So we can take for the entire 5 lakhs, it will be 1 lakh. Correct? Here it will be for 4,50,000. For 4,50,000, which will be what? 20% is 90,000. So it will be 1,15,000. But here it will be for the balance 75,000, it is 30%. So 75,000 into 30%. So it is 22,500. So it becomes 47,500, 1,47,500. So out of this 1,47,500, you calculate 3%. So that is 1,47,500. Then you calculate 4,425. You get how much? 151,925. And then you calculate 1,15,000, correct? So this is 1,15,000. 1,15,000 into 3%. So it is 3,345. So which is 118,345. Correct? So that's the total thing. So now you have calculated tax in all the cases. So whatever it is going to be, you have calculated in all the cases. So that's what you're actually doing it. So 115, 3,450. So now you have actually calculated the total thing. Okay. So now what happens is we are now moving on to understand how much difference you are actually getting relief for. So we said the current tax, excess current tax is higher than the thing. So what happens here is we'll have to actually calculate what is the tax including arrears for assessment year 22-23. So tax including arrear was 230,800. Tax on arrears, correct? That is what you call tax. We'll call it as excluding arrears. Tax excluding arrears. So what exactly it is? So excluding arrears is typically how much was it? 123, 240. Correct. So the difference will be 230,800 minus 123, 240. So it will be 1,07,560. So that is what it is about. Now you need to calculate for the old year. So that is step 2 of the calculation part. So now we'll have to call it as yearly arrears. Now you said what is tax including arrear. So what it happens? So tax including arrear will be 90,258 plus 116,802, 116,802 plus 151,925, 151,925. So this is the 3-year period. So I'm getting it as 90,258 plus 116,802 plus 151,925. So it is 358,985. So tax excluding arrears, correct? So what is the amount? 70,040 plus 92,700 plus 118,345. 118,345. So what is the total number? 70,040 plus 92,700 plus 118,345. 281,085. Correct? So what is the excess now? 358,985 minus 281,085. 77,900. So now, by paying it in assessment year 22-23, I'm going to pay excess 1,07,540, right? 560. But now, if I had paid it in that year, I would have only paid 77,900 excess. So now I'm going to pay how much? So excess tax is how much? This minus this, that is 1,07,560 minus 77,900. So it becomes 29,660. So that's what we are actually calling it as in the respective years. Correct? So now this is what you have actually calculated the tax in the particular. So this is based on whatever is provided as the rate slab here. So you would have been given the rate slabs. You would be given whatever is the rate slab. We need to just apply that. So whatever is the rate slab, we can actually apply it in the current period. So we have just used it whatever is available here For current period, since it is 46 years, we have used whatever is without the senior citizen category. If it's a senior citizen, we need to calculate as per the senior citizen category. When you are calculating this accordingly, we'll have to calculate for the rest of the years also. This is what we have done. So we need to calculate it for all the 3 years, and whatever the excess tax will be relieved. Please understand the concept. I've just slightly changed the question from what the illustration is. The concept is calculate the current year tax with arrear, without arrear, the difference. So that's step one. Step two, for all the earlier years, calculate with arrear, without arrear. So that difference is step two. If step one, section 89 that you get. So that's what it is about. Clear? So that's what this problem is about. So in your book, age is 16, yeah. So whatever I've done is based on the numbers I've given here in my calculation, in my problem. So as I told you, understand the concept. If it's going to be a senior citizen, you will have to calculate for the both periods with respect to the senior citizen. If you had paid in that year, in case in that year you will not be a senior citizen, then for the current year, you'll have to calculate it as a senior citizen. For the old period, you should calculate as if he is not a senior citizen. So depending upon that particular year, we'll have to apply that rate. So as far as your book goes, in the current year, he is a senior citizen. In the current year, he is a senior citizen, but in the old years, he is not a senior citizen. So that's how they would have actually calculated it. Pooja, what is 115 BAC? See, it's an optional rate. Probably it would have been discussed at the time of discussing the tax rates applicable for the current year. So I think it would have already been covered. It is not part of the salaries chapter. So wherever something is related to 115 BAC, I of course tell you. But I guess 115 BAC would have already been covered. If not, it would be covered in computation of income. Whenever you are actually studying a chapter, computation of income, 115 BAC will also be included. So either in the rates chapter or in the income computation of income chapter. So for time being, as you generally say, what should you understand relating to 115 BAC? 115 BAC is a section which is an optional tax slab. So you will have to calculate as per the existing slab, identify what is the tax rate under 115 BAC. You choose whichever is beneficial to you. So 115 BAC is an optional new slab rate for certain individuals. So that's what it is. Anyways, actual working of 115 BAC will happen during your computation of income chapter. Study material answer is different. Yes, of course, it's different because I told you I have worked out based on this slab rate and age 46 years. So please don't compare the answers as in the study material. Please understand the concept. So whatever we are doing here is to understand the concept, not reconcile with the study material, because I might have changed the question a little bit. In that case, please understand the concept alone. So what is the concept? Calculate tax with arrear, without arrear for the existing year. Calculate tax for the earlier years with arrear, without arrear. So let me again summarize. So step one, calculate tax current year. So A is with arrear, B is without arrear. So for step one, excess tax is equal to 1A minus 1B. Clear? 1A minus 1B. Now step two, calculate tax for earlier year. A with arrear, B without arrear. Excess tax. So the answer of step 2 is excess tax is equal to 2A minus 2B. Correct? So how much is relief under section 89? Relief under section 89 is step 1 minus step 2. If it is greater than 0. So otherwise, it is not. Of course, you can't claim negative, so you can't pay extra taxes. So you can only claim relief. You cannot pay extra taxes. So the relief is applicable when step 1 is minus, step 1 is greater than step 2. So that is what is actually the relief. Hope I have understand. I am not taking the wrong slide at all. Please understand. I am working based on the numbers I have provided. Whatever it is, I am working based on whatever on the slide. So there is nothing wrong or right. I am working based on what the numbers provided in this particular slide. So there is nothing wrong. So whatever is provided in your question, you are not going to go and check whether that year's slab is correct or not. You are not going to do that. You are going to calculate based on whatever numbers it is provided in that particular question paper. So forget verifying whether that slab is correct or not. Just calculate based on whatever numbers you have in front of you in the question paper. So please understand the step. Don't compare with the illustration 25 in the paper. Yes, I understand that it has been slightly modified from my end. I for screenshot of this Simran. See, anyways, I'll upload this working file also. I'll upload this note also. So maybe you can download it at later point in time, because there are multiple papers. So probably you taking a screenshot might be difficult. So what I suggest is I'll upload these notes also in the what you call in the portal in your concerned dashboard or whatever you call it. So it will be there. So that's what it is about. Okay. So on getting back to the 115 BAC, your 115 BAC will actually be discussed in chapter 8 on how to compute tax under 115 BAC. So for time being, if you have any doubts on 115 BAC, hold on till that chapter 8. So that is all about your salaries chapter. Imanshu, in year in which income is due is higher than which income is received. Actually, yeah, see, we said relief is applicable if step 1 is greater than step 2. If it is negative, then no relief. Okay. So let's say you have to pay 100 in step 1. This is 100. This is 120. Then no relief. Correct. Relief is applicable only when step 1 is greater than step 2. If it's otherwise, there is no relief. That's all. So for your question, Imanshu, when step 2 is greater, that is the taxes for the whole year is greater, the excess tax in the whole years is greater, then no relief. So no relief under section 89. Hope I have cleared. So that's all about your this particular salaries portion of this thing. So now we'll start with the next portion of next area of understanding. So what is the next chapter? The next chapter is house property. So we are going to talk about house property for what? For your current examination. So whatever is applicable in house property. So what do you all know about house property? So what is house property? So house property is typically what? There is a property. There is a property which is a house. There is a property which is a house. Is that easy? That's what your chapter house property is all about. We are going to talk about a property which is a house. So that's house property. So now to begin with, we of course need to understand what exactly is house property. So every chapter or every particular unit, a portion of it will have something called charging section. So I'm going to repeat this word quite often because it's very critical as you grow up in this concept of taxation. To have something as a taxable income tax somewhere should tell you that this income is taxable. So when we are actually discussing about this salaries chapter, okay, salaries. We said section 15. Section 15 is the charging section because section 15 tells you that income from salary is taxable to income tax on due or receipt basis, whichever is earlier. Correct? So that's what is your section 15 all about. That is about your salaries chapter. Now, for house property, you have section 22. So section 22 of your house property, section 22 Section 22 of your house property talks about Section 22 of your house property tells you that income from house property is taxable under income tax. So that's what it is talking about. So the income from house property is taxable. So that is Section 22. So that's what we are going to talk about. So this house property, again, see, whenever I'm talking about sections, I'm trying to compare with other sections that we have already studied. Why? So that you remember it better. So you compare one chapter with another chapter, compare the sections. What is chargeability in salary? 15. What is your house property? 22. Correct? So 15 and 22 are the two chargeable sections we are talking about. So you compare. So you now know that chargeability in house property is section 22. Now, house property chapter has sections covered is from section 22 to 27. This is what we are going to start about for the whole chapter. What is the overall topic about house property? So the first thing we'll understand is about scope. What do you mean by scope? We are trying to say, what are all the things that falls under this concept house property? What are all the areas that falls under this house property? What are the areas? We're talking about building. We said property. Property is a building. But please understand here, it says building or lands appurtenant thereto. Lands appurtenant thereto. So, to be precise, land alone is not covered under this chapter, house property. Land alone is not covered. Building or lands appurtenant thereto. So it should be a building or the land on which that building is situated. So a plain land, a vacant land is not covered under house property. Please understand that. So assessee is the owner. So if an assessee is the owner of that property for which of that property, then that comes under this chapter, house property. Now, what actually is chargeable? What is chargeable is annual value of the property. So when you say the property, it is building and land appurtenant thereto. So you're not only taking the vacant, you should not consider the vacant land, you are considering the land on which building is building lies. So that is what we are calling as annual value of the building and land appurtenant is there to chargeable. So what is chargeable to tax? Annual value of the property is chargeable to tax. That's the chargeability. Now the last one is the exceptions. So what is not actually covered under this house property? This chapter of house property. So please don't understand when I'm telling you exceptions, I'm not telling you it is exempt from the entire income tax. I'm not telling you there is an exception in this entire income tax. What we are trying to tell you is, what I am trying to tell you is, this exception refers to this particular situation. The particular transaction will not get covered under the chapter house property, will not get covered under the chapter house property. So what it is, portion occupied for business or profession. So if a particular property is occupied for own business or profession, then it is not covered. So it's for the own purpose. So when you say thing, own business. So if a portion is occupied for the own business, assessee's business or profession, then it does not come under the chapter house property. Similarly, assessee is engaged in the business of letting out. So what are we saying? We are saying the business of assessee itself is only to let out. So let's say I have 20 properties. I should be very rich, right? So let's assume, nothing wrong in assuming to be a rich person. So let's say I have 20 house properties. I don't do anything. I get up in the morning, just stay idle the whole day, just chit chat, watch TVs, etc., etc. I get income from this 20 properties. I don't do anything else. So my only income is this rental income, and I make money out of this rental income. So if my business itself is renting out, I may be an individual, I may be a company, but if my business itself is letting out, is renting of a particular property, then it will be covered under what section, what chapter? PGBP, that is profit and gains of business or profession. So this is the basic knowledge, basic overview you must have on this chapter, house property. So what is it? What is it? We discussed about the scope. We discussed about the chargeability. We discussed about the exception. So this is all about section 22. So section 22 provides that the scope of house property is about building and land appurtenant thereto, for which the assessee is the owner. And we said annual value of the property is what is chargeable to tax. Annual value of the property is only chargeable to tax, right? The last one, what did we say? We spoke about some exceptions. What are the exceptions that we are speaking? We said if assessee is conducting his own business or profession from his own property, then it is not covered. Similarly, which means I cannot pay myself rent. I cannot pay myself rent. So I'm an individual running a business in my own property. I cannot say I'm giving myself rent. So that's not allowed, correct? It's not possible, right? Recently, I read that, of course, right? You cannot do it within yourself. So I cannot earn it for myself. So now, whatever I'm earning, if it's my own business, I'm occupying the property. I cannot pay rent to myself. So that's what it is about, the assessees in the business or profession. Then what did I say? Another exception was if the assessee's primary business itself is into letting out, is rental income, then it could be categorized as PGBP and need not be categorized as income from house property. So we are not talking about one or two properties. We are talking about multiple properties, and we are only talking about that's the only source of income of that person with which they are making an income. So that's their business. Their business is purchasing a property or building a property and letting out. Please understand, their business, their primary activity itself is buying a property or building a property and letting it out. So that is also not covered under this chapter, house property. Why? Because it is covered under the chapter PGBP, because it's about business. Clear? So that's what we are talking about, this particular thing. So now we'll move on. We'll move on to the next area. We'll continue this overview itself. So we spoke about certain key terms, right? We said property, we said building and land appurtenant there too. So we have been speaking about certain key terms. We'll understand the definition of property. What does the word say? What does the word say? It says house property. So what does the chapter say? It says house property. Each one of you listening right now will think house as what? House as what? A place where you stay with your families or something, right? So that's what house is about. So what do you mean by the categorization? We will generally mean when you say house, what do you mean? You mean residential. But income tax says house is not only residential. So even a commercial complex, let's say I have a commercial complex where I have let out 4 buildings. I'm a salaried employee. I also own a commercial complex. I am getting rental from 4 properties. Let me write that for you. Seems to be a good example. So I'll write it for you. Salaried employee. Okay. So he receives salary. Okay. Plus rental income. Say this is an IT company. And here, what is he let out? A complex with 4 shops. So now, since his business is not letting out, because he's also a salaried employee, this is covered under, I'll just use a different color to mark it. So this is HP. What is HP? Not Hindustan Petroleum. In income tax, HG refers to what? HP is not Hindustan Petroleum. HP refers to what? In income tax, whenever we are saying HP, it refers to house property. Correct. So rental income from a complex with 4 shops is also income from house property. Why? Because he is not in the business of letting out. He is also a salaried employee. So in this case, this is also house property income. So that's what the provision says. So it says not only residentials. So buildings does not include only residential buildings. It also includes factories, shops, godowns, warehouses, or whatever, any commercial premises. So please understand that. So don't get confused with this word house. It just it's like an illusion. So it's not the actual term that they're referring to. They're referring to any property, not a residential house alone. Okay, so they're referring to anything with a shelter. Now, the next thing that they're saying is land appurtenant thereto, correct? So they also said building on land appurtenant thereto. So what do you mean by the land? What do you mean by the land appurtenant to? When you say land appurtenant to, it includes that building. So the word appurtenant here too. So the word appurtenant we refer to. So we'll call it as, I guess I'm writing it correctly. So upper tenant, right? Upper tenant. So upper tenant. So now this land appurtenant actually means it not only includes, when you say house property, it not only includes the building, it includes a land which has a building, So vacant land is not an income under house property. Please understand again. I am telling you, vacant land is not taxable in house property, but it is taxable under some other head. It could be business or profession, or some cases it could also be income from other sources. So that's what we are actually referring to. Land, a vacant land. A vacant land is actually taxable IFOs or PGBP. IFOs is income from other sources. PGBP is profit and gain from business or profession. Correct? So that's the first thing. So what is building about? So when we say building or land apparent to, what is the building refers to? So what actually refers to the building? So that's what we are talking about. The second concept, what that we wanted to understand is ownership. We are saying, when we discussed in the earlier slide, we said building or land appurtenant to, for which assessee is the owner, So we need to understand the concept of ownership. What do you mean by ownership? What is ownership? Ownership is basically something you own, something belongs to you, correct? Now this ownership could be in various categories, okay? So ownership could refer to the ownership of the income, not the building. So that's where we are using this term beneficial ownership. What are we saying? Beneficial ownership. So beneficial ownership is, let's say now I have built my property. Okay, I have built a property, but I am not actually receiving the rental. I am telling, let the rent go to my spouse. Let the rental go to my spouse. Now, that rental income, my spouse becomes a beneficial owner. So she starts receiving the rental. She has to pay income tax on that. I'm saying it is her income. Okay, for time being, if some of you know the concept of clubbing, please forget. Okay, because whenever I tell the spouse income, I am giving property is mine, income is spouse. Some of you start questioning, is clubbing applicable? I want the chapter of clubbing be applicable. Yes, of course, clubbing will be applicable on various situations. But for time being, forget clubbing. I am only giving a small example to understand the concept of beneficial ownership. So property is mine, is in my name. So I am the legal owner, but the rent is actually received by my spouse. Now my spouse becomes the beneficial owner. So this is where we are talking about. So for time being, just forget the concept of this clubbing or deemed ownership. We'll see that a little later. So beneficial ownership is someone who's receiving the income is not the legal owner. Let's say I'm giving it to my father. So my property, but my income is received by my father. Father has to pay the tax on that. Because he is the one who's entitled to receive the income. So please understand, when you say beneficial owner, it's not the legal owner of the property. It is the owner of that income. Next, what you're saying is, there is no requirement of sale deed and all to prove that it is your property, it is in your name. So you need not prove any legal right. So there is no requirement for you to prove legal right of that property. What you need to do is, you must be receiving that income of rental income. So no one need to tell you that you are legally eligible to get that rental. If you're receiving the rental income, it is taxable. So sale deed is not required. Sale deed is not required to prove that it must be considered under house property. So you need not be the beneficial owner. You need not have the sale deed also. So nothing is required. And final next one is when you say ownership, you might be a beneficial owner who has leased the asset. Okay, I have leased a building, I've let it out. Now, this lease, a person who has actually leased, now is the current owner who is entitled to receive the income. So, ownership includes both freehold and leasehold rights. Freeholders, I am the legal owner itself. Leaseholders, I am not actually the legal owner, but I have got the right to use that property for time being. So, I guess you would have heard the concept of lease probably in your 11th, 12th standard also. So in your earlier age of your schooling, probably you would have understood the concept of lease. So lease is basically, if I am the owner, I've given the right for someone to utilize the property, and they might let out or do whatever they want. So the property that you are referring to, the building and the land appurtenant thereto, for which you need not be, you can either be the freehold owner or the leased owner. So that's what it is there. And even if building is yours, you can say that land belongs to someone. I only built a property on that. So you need not be the owner of the land. You need not be the owner of the building. You need not be the owner of the land. If you have the right to receive that income, it automatically becomes taxable. And whenever we say ownership includes deemed ownership. As I told you, it's something like clubbing. We'll see that at a later point in time. So that's what it is. So ownership is another good point that I want to tell you is ownership is irrelevant in recovery. Let's say I was supposed to get some income. I did not get. Now I've sold that property also. So I'm not the beneficial owner. I'm not the legal owner. But when I'm subsequently recovering, even if I'm not the owner, it is still taxable. Okay. Even if not the owner, I'm still taxable. So let's say I purchased house in 2018. Now I let out in let's say this is May. I let out in October 2018. Okay, I've been letting out. Now I've sold in June 2021. No failure in rental. Okay, failure in rental from let's say January to May 21. Okay, the person who was actually in my property has not paid rent from January to May of 21. So they have not paid. We'll actually take it as a different month in the same year. We'll take as April to June. So there is no rental payment between April to June. In June, I am selling it. Now, received arrear in October 2022. In that year, am I the owner of this property? Because I have actually sold it, correct? I have actually sold it. So I am not the owner of the property. The provision says it's fine. You need ownership is irrelevant at the time of recovery of dues, recovery of whatever arrear rental I have. So that's what this is about. Correct? So this is all about your concept of ownership. The next concept that you need to understand is use of property. How should the property actually be used? We gave an exception, right? That the property should not be used for the own business. When an individual using for the own business cannot say I am receiving rental. So I cannot give rental to myself, right? So for that reason, what happens is this use of property can be used for any purpose, but only thing is not for the own business. So because when it comes to own business carried on by himself, you cannot say I paid rent to myself. So I'm repeating the statement repeatedly. So that's the point. And then similarly, if he is the business of letting out, it will come under PGBP or whatever, correct? So that's what it is about. So he is not in the business of letting out. So for the use of property, we are trying to say it should not be used for your own business as an individual, should not be used for your own business. Similarly, it is not in the business of letting out. So which means if it is in the business of letting out, it will be treated under what? PGBP. So next is stock in trade. The fourth thing that we are going to understand about the overview of this house property chapter is stock in trade. And this is a fairly new provision, probably a couple of years old or something. What is this fair stock in trade? Stock in trade is I am running a business. I am having a property to sell. I'm having a property to sell. So let's say I am this ABC company. ABC company. So this ABC company is actually owning multiple property. So owning multiple properties. Property 1, property 2. This is for sale. Okay. This is for own use. Now this will become stock, correct? So whenever you call whenever you call it as for sale, it is stock in trade. Now it cannot lie idle as stock in trade for several years. So there was this amendment which brought in and said, see, annual value of house property, whatever is annual value, will be nil for the first 2 years. So you can treat stock in trade's annual value as nil for the 2 years. After the second year, from the third year, you must charge some annual value and treat it as a deemed income. So even though you're actually not letting it out, you must assume it that it is letting out. So it is 2 years from the end of the financial year in which completion certificate is obtained. So now this property, let's say it was completed on 10th May 2018. We are saying 2 years from the end of the financial year. Please read the word again. 2 years from the end of the financial year in which completion certificate is obtained. So what is the end of the financial year here? The end of the financial year is 31st March 19. 2 years plus from here. Okay, so that is nothing but what? 31/3/21. 31/3/21. So in financial year 2021, that is deemed income. Deemed income in financial year 21/22. Correct? So that's what we are actually saying. So this is all about the overview of the house property. So we'll take a short break for 10 minutes. When we come back, we'll continue with the rest of the house property section. So we'll meet after a short break. Thank you. So as we said, we'll discuss some of the questions before we move on to the next slide. Hitesh wanted to understand about the word upper tent. So upper tent, yeah, it is basically, you can't call it as connected or joint. It's basically, there is a land, and of course there has to be a building above that. In simple terms, what you can keep is vacant land is not covered. Only if there is a building on top of the land, only then it gets covered under this chapter of house property. Now the question comes, I have a very huge land, I have a very small house. So there is vacant land around my house. That is okay. We are not talking about the size of the building. We only say there must be a building on that land. Only then it gets covered under this topic of house property. And Hitesh, yeah. So lease means it is actually you're letting it out only. You let out for certain purposes. So you're leasing out to a particular person. So lease out is also a kind of rental only. So it could your land could be a leased land. So you don't own the land, you have leased the land on which you have built a property. So that could also be the case. So that's why we said freehold land, leasehold land. On a leasehold land, I'm building a proper building. It's okay. It's okay to build that. And what happens when owner is of the same property on which he's receiving rental also? Let's say, if I guess I've understood your question properly. Let's take, you have a property, there is ground floor, first floor. In ground floor, owner stays. First floor, you have let out. Now, can you say owner is receiving rental for the same property in which he is surviving? That's not what it is. Now, this ground floor is an independent property by itself. First floor is an independent property by itself. So the rental I'm collecting is for the first floor. So it is okay. So that is okay in collecting rental, and it will be treated under house property. And next one again from Aita, it is about dispute in court. So if there is a property in dispute in court, what happens? See, as long as you are the legal owner, or as long as you are the beneficial owner, till there is a court ruling which overrules your ruling, you are still eligible to treat it as your own property. So during the dispute, whosoever is actually the legal owner or beneficial owner will continue to claim that income under house property. So only after the ruling, the situation might change. So that's what for dispute of court. Shreya, sublet. It's actually a good question. See, as far as subletting is concerned, it is not covered under house property because he is neither the legal owner nor the beneficial owner of that rental income. When you say legal owner, they actually own that property, correct? Legally. So the sale deed is in their name. When you say beneficial owner, the legal owner allows the beneficial owner to receive the income on their behalf. They want them to enjoy the benefits of that property. So beneficial owner is not about the income alone. It is also about the beneficial owner of the property. So they have the ownership in that property. So this sublet, whatever we are talking about, doesn't come under house property because they are not the legal owner or the beneficial owner of that property. Mansha, stock in trade. Yeah, stock in trade, you're right. It is something like a real estate company owning some property who is engaging, selling and buying a property. When we said assessee is in the letting out business, please understand the difference. When you say stock in asset, we are referring to stock in asset which is supposed to be sold, which is kept for sale, which is not kept for real estate. So we are differentiating. We are only picking properties which are held by real estate companies as stock in trade, which they're trying to sell, but they're not able to sell it for 2 years. Probably we can keep it as a vacant property. Vacant stock in asset for more than 2 years will be considered as house property. This is a very clear instruction in house property for stock in trade. So which means they know that their business is probably buying and selling of property. It should still be considered under house property. So it's typically only in this scenario, even if your business is letting out, this income will come under house property because you're only saying that a stock in trade which is kept for sale, not being sold. We are not talking about the letting out of a property. We are talking about a vacant property which is kept for sale but not sold for a period of more than 2 years. please explain ownership point again. See, basically the ownership point, when you say ownership, we said beneficial owner. Beneficial owner is someone who's not the legal owner. Beneficial owner is someone who's not the legal owner, but is entitled to use the property, who's entitled to use the property on their own. So that's what it is about. So beneficial owner is basically not a legal owner who can enjoy the property on behalf of the legal owner. So that's what it is about. So as I told you, it could be a parent-son combination or some combination where legal owner will be someone, a beneficial owner will be someone. So that's what it is about. So now we'll start with the next slide. We'll move on. So we have discussed about the overview. So the next one that we wanted to discuss about is concept of composite rent. Concept of composite rent. So what do you actually mean by composite rent? What I'm letting out is not only the property, but also assets and amenities. So I'm also letting out assets and amenities, which means, let's say, furnitures, or if it's a commercial complex, it's workstation. So I'm not only letting out the building, but I'm also letting out various amenities like your electricity, the fittings of electricity, the furnitures of whatever it is. So everything is being given additional. So what about those amenities? So if it is combined, how do you do it? So we'll just see the meaning first. So the rent for property is not only for the rent, but also for other assets, correct? So that's what the meaning of composite rent is. What about the taxability? Property is taxable under section 22, that is taxable in house property. Whereas services, that is the facilities provided, is taxed either under PGBP or income from other sources. So please understand, the property is taxed under house property, but these services are taxed under IFOs. So this is the taxable scenario. But now there is a small twist to this. What twist? There could be a situation where I don't give the bifurcation. How much is building? How much is services? How much is property? How much is services? Owner, I don't give that bifurcation. I tell you the rental is 30,000 for the property and the furnitures and all the benefits. Now I don't know the split. I'm not giving you the split, or rather, I don't know the split. I don't know how much is towards building. I don't know how much is towards the services. In that case, if the base is inseparable, the entire income is taxable under PGBP or IFOs. If it is separable, respective heads. Property is taxable under section 22. Your other amenities and services will be taxable under PGBP or IFOs. So that's what it is about. So that's about your composite rent. Now, what if the property is situated outside India? Right? Because in case of property situated outside India, there we need to understand what happens if he is a non-resident, what happens if he is a resident ordinary or not ordinary resident. So your not ordinary resident or resident. So we have three categories, right, for individuals: resident, ordinary resident, not ordinary resident, or non-resident. So as far as your resident is concerned, if a property is situated outside India, it is taxable whether his income is brought to India or not. So if they are resident, it doesn't matter whether the income is brought into India or not. You would have already discussed chapter under for the residential status chapter, section 5 and 6, where you would have understood what is the scope of taxing an income. So if it is an income from house property, if it is an income which is either accrued or received in India, it is taxable for all persons, that is resident, ordinary resident, not ordinary resident, non-resident. But if such income is not deemed to accrue or received in India, it is taxable only in case of resident and ordinary resident. So that's what we are saying. It is taxable whether if he is a resident and ordinary resident, it doesn't matter. Wherever the house is, wherever he receives the income, it is taxable to that person. But if he is a non-resident or not ordinary resident, it is taxable in India only if the income is received in India, because the property is outside India. So it is taxable in India only when your income is received in India. Please remember the word received in India. So if I'm receiving it in India directly, it's not something I've received in abroad I'm transferring it to India. That's not what we are referring here. We are saying it is received in India itself. So that's not what we are saying. So we'll take an example. US house rent to US account, then transfer to India account. Transfer receipt. So now what we are saying is not this. What we are saying is US house receipt is an Indian account. Only then it is taxable in the case of resident and ordinary resident, resident and not ordinary resident and non-resident. Only in that case it is actually taxable. So that's what it is about. Okay, so that's about composite rent. Swati, in exception, if an individual is a partner in a firm and uses personal funding. Yeah. See, partnership is a different person, individual is a different person. The question by Swati is, if we said it should not be used for own business, assessee should not be using it for own business. So now our question is, what if it's a partnership firm in which he is a partner? Okay, in which he is a partner. Now that property is held by the individual, rent paid to the partnership firm. These are two different persons, not the same person. Here the assessee is individual. In partnership firm, the assessee is the partnership firm. So these are two different persons. So it is still taxable under house property. So the point we were referring is only in the case of individual itself, not in case of partnership firms. Clear? Okay. So moving on. The next thing that we need to understand is the format. Now we'll just understand this. Every chapter that we are discussing, first thing we understand is what is charging section. Then we understand the basics of what that section is all about. Immediately after that, one important thing that we need to understand is how to compute income under that particular head. What is the format? What is the template? Why is this important? You need to replicate this exactly in your question paper, in your answer sheet. Whenever you're answering a question on house property, this format should remain. There is no deviation from what it is. Similarly, you will have this for every chapter that we are talking about, capital gain, your business or profession, whatever it is. There is a format, there is a structure. Remember, there is a structure given in your study material on how to compute. So we are going to discuss it right now for house property chapter. How do you do it? So the first thing that we need to understand is you compute the gross annual value. Okay. What is gross annual value? We'll understand in the subsequent slide. Whatever I'm going to use the terms here, don't ask me questions in this slide. I'll move on and explain you. When you have questions in that particular slide, please request. So as of now, the term is the term. There is no explanation that I'm going to give you now. So you identify, you determine the gross annual value, reduce municipal taxes. With that, you get net annual value under section 23. From that, there are deductions available. There are deductions available under section 24. Now, I told you linking provisions will help you understand the provisions better. Now, when I use the word deductions, what do you remember? You have deductions in salary chapter also. What is the section there? So deductions under salary chapter is section 16. Section 16. 16 provides you deduction for standard deduction, entertainment, and professional taxes. So here the deduction section number is 24. Deduction section number is 24. So that's how you link and understand. So now when I remember 16, I'll also remember 24. When I remember 24, I'll also remember 16. Clear? So that's how you remember income tax. You link provisions. You link one or the other and try to remember it as a whole picture. So that's what it is about. Clear? So this is one of the methodology which you can adopt across the taxes that we are going to study. Okay. So what are the deductions available? The first deduction, that is clause A, is 30% of net annual value, which is a flat deduction. So I'll use the word flat. Now I'm again going to compare you. 16, first deduction under 16 is what? Standard deduction. So what does standard deduction say? 50,000 or salary income, whichever is lower. 50,000 or salary income, whichever is lower. So it's not a flat deduction. It's not a flat deduction. But here in house property, 24 clause A provides you a flat deduction. So flat deduction of 30% under clause A. Okay, 30% of what? Net annual value. The next one, that is section 24, clause B. Clause B, what is it? Interest on borrowed capital. So whatever monies you have borrowed, the interest on that capital is all allowed. So finally, you get income from house property by applying this simple formula. Okay, simple formula. So income from house property under section 22 is calculated after finding out net annual value under section 23, adjusting for deductions under section 24, you get income from house property using this formula. So that's the computation mechanics. What do you mean by it? In simple words, as we all can understand, it is a format, it is a template. So what is the simple word for this? Format. So this is a format, or you can call it template. Okay, so this is what it is. Now, moment I use the word gross annual value, what would have been in your mind? What is gross annual value? Correct? You wanted to understand what is gross annual value. Can we understand it right now? What is gross annual value? So in this slide, I'm going to discuss about calculating or determining annual value only in case of let out property. Only in case of let out property. So what exactly should we do for let out property? We are going to calculate two things. Okay, calculate two things. First is expected rent. Okay. Second is actual rent. We are going to calculate two things. We are going to identify expected rent. We are going to identify what is actual rent. So higher of this two is your gross annual value. Should I explain you what actual rent is? Nothing, right? If my rental is 10,000 per month, my actual rent is 1,20,000. Correct? 1,20,000. So that is actual rent. Now, what is expected rent? What is expected rent? What is the word there? The word is expected. The word is expected. So what do you exactly mean by the term expected? Expected is nothing but it says your expected is typically, the word says, when you say expected, it typically talks about the term what could have been the rental. What could have been the rental had you let out in that market rate. So the expected rent is something like market rent. So that's what we are going to understand how exactly we need to calculate this market rent. That is your expected rent. So I'm going to call this as ERAR. Okay, I'm going to call this as ERAR. Now, for this ER, that is expected rent, we are first going to calculate higher of fair rent and municipal rent. So this is 1A. So in step 1, I need to identify expected rent. In that step A is to identify higher of fair rent and municipal rent. So what is fair rent? It is the market rent. It is a market rent. So when you say market rent, whatever is actually the possible rental value that could be there in that particular area. Let's take probably an area in Mumbai, possibly a very luxurious area or something. Now it could be there, a single bedroom apartment of particular square feet is worth 45,000. The market value, whatever is you provide is a market value. Generally, that is how you determine, right? The market value. So now if you wanted to let out a property that you are currently living in, how will you determine? You will check out in your neighbors, right? What is the rental? What is the rental that you are charging for your 2-bedroom apartment? So now if you wanted to let out for your own apartment, you will check with other building people, your neighbors and other thing. You will see if you have some extra benefit, amenity or something. Accordingly, you will vary your rental. Correct? If someone tells you the rental is 20,000, if yours is exactly same kind of property, you will also say 20,000. So the fair rent is the market rent, which is possibly the rental value in that particular area, the applicable, practically applied value rental. Next is called municipal rent. What is municipal rent? If some of you have an idea about these properties, there is something called that you need to pay on for that property, something called property taxes. Okay, property taxes. Now, for this property taxes, what you call is municipal taxes. So you pay taxes for owning that property. Now, how is the tax determined? It is determined based on a valuation. It is determined based on a valuation set by the government. So that valuation will give you a municipal rent. So that is municipal rent. So you have the market rent, you have the government tax rent, that is municipal rent. Whatever is being charged as property tax or something, on that rate you calculate a rental value. So that is called municipal rent. So you can take the fair rent, you take the municipal rent, whichever is higher becomes your rental value. Now, it is restricted to standard rent. What is the standard rent? Typically, every area will have a standard rental value, which is kind of an act, rent act, where you say you cannot charge rental beyond this value in this particular area. For that particular street, you can only charge this much of rent. So this is a standard rent, which is a statutorily recommended rent. So you are not supposed to generally collect above that. So standard rent is something which is the government recognized rental value. Okay, so these are the three numbers. So what are the terms we are seeing now? We are seeing fair rent. It's something like your market value, correct? Something like your market value. And then we said municipal rent. Municipal rent, something based on your, let's say, municipal tax. I'll call it MT. MT is municipal tax. Municipal tax valuation. So based on that, you get the municipal rent. And finally, you have standard rent. Standard rent. So what exactly is standard rent? Statutory rent. Statutory rental value. Statutorily prescribed rental value under some rent act. Let's keep it like rent act. There is an act which tells you in this location, you should only charge this much rental. So it's a standard rent. So these are the three values that we should actually take into consideration. Now, these two, the first two, you take whichever is higher. For the first two, you take whichever is higher. And then for this, you take whichever is lower. Clear? So what am I saying? I'm saying take fair rent or municipal rent. You consider whichever is higher. Take standard rent. Now take whichever is lower. So this is the two-step. It's something like a two-step authentication. Some of you who are using your Google Drive, Facebook, or whatever social media, you would have heard about two-factor authentication. So you need to do 2 steps to actually log into your social media account, correct? So here, to know the expected rent, to understand the expected rent, you need to do 2 steps. So what is the first step? You take fair rent, municipal rent. So FR, MR, whichever is higher. Okay. Now, this is standard rent. Now, this is whichever is lower, correct? So let's say fair rent is 100. Municipal rent is 80. So this becomes 100. Okay. Now let's say standard rent is 70. Standard rent is 70. So now what are we saying? We are saying whichever is lower. So 100 or 70, whichever is lower. So what happens? 70 becomes your expected rent. 70 becomes your expected rent, or what? Called as ER. Correct? So this is what it is about. What are we saying now? We are saying fair rent or standard rent. Fair rent or municipal rent, whichever is higher, subject to maximum of standard rent. So whichever is lower in this case. So that's what we are doing it. So please understand, you identify fair rent, you identify municipal rent, you take whichever is higher. That is step A. So this is step A. and this is step B, whichever is lower. So that result plus standard rent, you take whichever is lower. So that's what your expected rent is. So now after calculating this expected rent, this is what the expected rent after applying step 1A and 1B. Now you need to calculate actual rent. Actual rent is straightforward, whatever is the actual rent. But sometimes what happens is there might be this factor called unrealized rent. Unrealized rent. What exactly is unrealized rent? In this case, let's say you only paid 8 months. So my actual rent is actually 1,20,000, but my unrealized rent is 40,000. That is 4 months, correct? So my actual rent will become 80,000 because I'm not realized my rental. Whenever you are realizing it subsequently, it becomes taxable at that point in time. So for time being, since you have not realized the rent, income tax says don't pay taxes on that. Since you have not received your income, don't pay taxes on that. So that's what is, we need to adjust unrealized rent with the actual rent. So, but to say that it is unrealized rent, income tax gives you certain conditions, saying that only if you satisfy this, it will be called as an unrealized rent. What exactly is the condition? First is a very beautiful word. Have you heard these words? Bona fide. Bona fide is generally in good terms. Okay, generally in good terms. So whatever you are saying is very reasonable and in good sense. So yes, it is actually an unrealized rent. You are not lying. Whatever you are saying is true. You are not lying. So that's called bona fide. So bona fide is true. The statement that you are saying, I have received rent only for 8 months. I have not received it for 4 months. This statement should be a bona fide statement, which means it should be a true statement. So bona fide statement is nothing but true statement in good terms. And next is no other property of assessee. So basically what we are saying to say is the same tenant should not be occupying any other property of the assessee. Let's say I have one property in Chennai, one property in Mumbai. Same tenant has occupied my property in Chennai, in Mumbai. He's paying rental of Mumbai, but he's not paying rental of Chennai. That's not right. So that's what they say. They say no other property should be held of that assessee should be owned. So that's what it is about, correct? So now we have calculated the actual rent, and we are trying to prove that it is actually unrealized. So we said it must be bona fide. We said it must be no other group of the property of the assessee should be taken into consideration. So that's what it is there. And then we say steps to vacate. So you have actually taken steps to vacate. So that's what we are actually calling. So how do you prove that? You can say that you sent a notice, you sent a mail, you used to call him regularly, so whatever it is. So basically, you are trying to actually prove that it was you have taken steps to vacate the property. So that's what it is about. And steps to legal proceedings. So steps to legal proceedings. So what is about legal proceedings? So legal proceedings, if you have not recovered the money, you can also say that you have taken steps to get back the money. You have filed a case in the court to collect back the rental. These are not under condition. So if some of these conditions are satisfied, it is okay. You need not satisfy all these conditions which is provided here. So please understand, all these conditions are basic conditions which need not be completely satisfied. It is okay if you are satisfying only some of the conditions. So that's what it is about. Okay, so that's what expected rent is. Actual rent is all about. So now what is actual rent? You are calculating the actual rent for the whole year, rent receivable minus unrealized rent. So that's what AR stands for, actual rent, or your receivable, not receivable, minus, in case of unrealized rent. What do you mean by unrealized rent? It could be that you have not been able to collect it back from the person. Or it could also be a case where you are saying it is vacant. So you are not able to let out itself. So that's also there. So basically, unrealized is rental, which actually you are not able to collect it. It's a very bona fide statement. And then you're also saying that There is no other property occupied the assessee, and we are also saying that you have taken steps to vacate and you have also initiated legal proceedings. If some of these conditions are satisfied, it could be called as a actual unreleased rent. So that's what this is about. So we are explaining you only on that. Now we'll move on to some illustration to understand how this works out. Okay. So typically the question is about, there are 5 houses given for this person. Jayashree owns 5 houses in India, all of which are let out. Now they've given you municipal value, fair rent, standard rent. So according to us, I'll probably tell you our code. This is FR, this is MR, this is SR, this is what? AR, actual rent received or receivable. Okay. Now, what is the first step? What is the first step? First step is fair rent, municipal rent, whichever is higher. Second step, what? Step one, and your standard rent, whichever is lower. So step 3 is expected rent and actual rent, whichever is higher. Correct? These are step 3 steps. The first one, municipal rent is 80,000, fair rent is 90,000, whichever is higher, correct? So 80,000 or 90,000, whichever is higher. So which is higher? Very simple, right? 90,000. So a higher of one will be 90,000. Now there is no standard rent. Standard rent is not been provided. So when standard rent is not provided, you can ignore that. Consider this fair rent itself as the final what you call expected rental. So fair rental, since standard rent is not available, you can actually consider this itself as the standard rent. So now this becomes 90,000. And then you are talking about the word actual rent. So what do you mean by the term actual rent? This is 72,000. So whichever is higher, 90,000 or 72,000, whichever is higher. So the gross annual value will be 90,000. Correct? Gross annual value will be 90,000. Because how did we arrive? Expected rent, that is fair rent or municipal rent, whichever is higher, subject to maximum of standard rent. So that's what we are actually calling it as expected rent. From there, we are actually comparing with the actual rent and considering whichever is higher. Now just go through the second one on how to go about it. It has given municipal value 55,000, 55, 60, 75, 72. Your MR is 55. Your FR is 60. Standard rent is 75. Actual rent is 72. Okay. So what is the first step? MR, FR, MR, whichever is higher. So in this step 1, in this step the winner is fair rent. So you take 60. Step 2, you take step 1 divided by standard rent. You take whichever is lower. So here it is 60, here it is 75. So you take 60, correct? 60. So that becomes the expected rent. So this becomes your expected rent. So what is actual rent? AR. Step 3 is actual rent. So what is the actual rent? Actual rent is 72,000. I've actually written it here itself, right? So okay. So actual rent is 72. So your expected rent is 60. Your actual rent is 72. So what becomes your AR? So fourth is ER, AR, whichever is higher. So in fourth step, you decide that 72 will be the this expected your gross annual value. Can we do this for the other thing also? The third, fourth, five. Why don't you just take a moment to understand that? Just check out 3, 4, 5 and see if you can actually identify this particular concept. So what is third? Municipal value 65,000. What is fair rent? 65,000. So nothing to do. Municipal rent or fair rent, both are equal. So 65. Subject to maximum of standard rent. So that is 58,000. So now your expected rental is 58,000. Whereas your actual rent is 60,000. So what becomes the gross annual value? Gross annual value will be 60,000. Because whichever is higher, 58 or 60,000, whichever is higher. So what about 4? 24,000, 25,000, whichever is higher. So you take 25. 25 or NA, you again take 25. Now 25 or 30, whichever is higher. So the answer will be 30,000, correct? House 5. What is municipal rent? 80,000. What is fair rent? 75,000. So now 80 or 75, whichever is higher. I take 80. Now 80 or 78, whichever is subject to your less item, right? So now you take 78. You leave out this 80. Now 78 or 72, whichever is higher. So you leave out 72 also. So out of this, your gross annual will become 78. So that's how you actually calculate gross annual value. Gross annual value is determined by basic rule. It is fair rent or municipal rent, whichever is higher. Okay. Then this result with standard rent, whichever is lower. So now that is expected rent. You compare actual rent after adjusting unrealized rent. Now this expected rent or actual rent, whichever is higher, will be considered as your gross annual value. So any hope it's pretty clear on how exactly you need to calculate gross annual value, because that's the basic thing for a gross annual value. So with this, I'll just stop it here and see if there are any questions. Shreya, if I'm getting monthly rental income from a huge land and the person to whom I've let out the property uses the land for fair or any kind of public event, then whether it will be included in house property. See, if it's only the land, it doesn't come under house property. It will come under your business or profession or income from other sources. So if it's only for land, build some temporary structure is built and rent is being received, it is not applicable. So when you say building, it is a permanent structure. It's not a temporary structure like you just set and remove it off. So it's not like that. Mansha, whether all 4 conditions to be satisfied as unrealized rent? No. These are not basically and conditions that we are talking about. So whatever we are talking about, these conditions for receipt of rent is typically only in case of what you call. It's basically an and condition. So whatever is unrealized rent, it should either, to a great extent, it should be true. It should be bona fide or something. So it's not necessary that you might have actually started a legal proceeding and all is not required. So it's not actually an and condition. It's only a some of the conditions. It's not even or. It's not or and. Some of the conditions should be satisfied. So some of you answered 72,000 for house 1, which is not right. It is 90,000 for house 1. It is 90,000. Why 80,000 or 90,000? Whichever is higher. Since there is no standard rent, you ignore this. So 90 or 72, whichever is lower, whichever is higher. I'm sorry, whichever is higher. So which is higher, 90 or 72? 90 is higher. So that's why 90,000. The second question, 55 or 60, whichever is higher. So that is 60. 60 or 75, whichever is lower. So 60,000. 60 or 72, whichever is higher. So you take 72. So 72 becomes your, correct? Yeah, so house to 72,000, good Akash. 60, 60, 25, 72. How did you get? Okay. Second is 60. Second is 72. I guess you're confusing in the last one. Expected rent or actual rent, whichever is higher, whichever is higher. Let me go back to that slide. Expected rent is higher of fair rent and municipal rent. Step one. Step two, compare to standard rent, whichever is lower. Compare to standard rent, whichever is lower. Then you get expected rent in step 3. Now calculate actual rent in step 4. So now this rental minus or actual rent, whichever is higher. So that's what it is about. So don't get confused with what is happening in the higher, lower. Keep it very clear. Okay. Keep it very clear. Whichever is lower. So that's what it is about. So that's what this question is about. Hope all of you have got. Mansha, whether this rental includes adjustment of unrealized rent. The question doesn't talk about unrealized rent, so we can actually leave it. In case if your question has a number of unrealized rent, you need to adjust it. You need to adjust it with the actual rent. So that's what it's about. Let's say in this case you had 10,000 of unrealized rent. This becomes 20,000. This becomes 20,000. Correct? In that case, what happens? This 25,000 will become the your what you call the gross annual value. So that's what it is about. Clear? So now I'm going to get into section 23, where this 23 tells you about what net annual value. Net annual value. So what is net annual value? Gross annual value minus municipal tax. So NAV is equal to gross annual value minus municipal tax. Please understand, it is gross annual value minus municipal taxes. That only is your net annual value under section 23. Now in this 23, there are various situations. What kind of situation? I could have a property, it was vacant for some time, or I could say that it was actually self-occupied. I myself occupied. There's actually no rental income. Or I could say that it was self-occupied for part. It was let out for what? Please understand, I'm trying to tell you various combinations in which the property could be let out. So we are going to see one by one in this. So first thing is, we are going to understand about what about vacant. What if it is vacant? So vacant for part of the year. So that's what we are actually discussing about. So what do you mean by vacant? So it is vacant. So that is 23(1)(c). So when you say vacant, what are you exactly meaning by vacant? I am trying to let out or whatever it is, but I'm not finding a tenant. There is no one living in that particular house. So it is totally what? Unoccupied. It is unoccupied. So where a let out property is vacant, what happens is when a let out property is vacant, we need to adjust based on certain principles. What principle? Actual rental is less than expected rental. Okay. Actual rental is less than expected rental owing to vacancy. Then actual rent shall be the gross annual value. I'm going to give you an example. So what example I'm going to tell you? I'm going to tell you 10,000 per month rental. Okay. So now let's say my annual will be 1,20,000. If I had actually let out throughout the year, let's say they were actually occupying only for 8 months, then they quit and they're moving out of the house that I've letted out. So what happens? Lived, we'll keep this as lived 8 months. Okay. So 8th month will be November, right? So they vacate on 30th November 2022. We'll keep it as 21. 30th November 2021. Now, from the period December 21 to March 2022, it is vacant. Okay. Now, let's take an example. Your what you call your expected rent. Okay. Let's say your municipal rent is. We'll take the same example whatever we discussed. Let's take it is 80,000, and your fair rental. Your fair rental. Let's take what was it in house number one. We'll just that itself 90. So your fair rental is 90,000. Standard rental is, let's say, 95,000. Okay, 95,000. Standard rental is 95,000. Now, we said whichever is higher. Okay, so it becomes 90,000. Now, out of this 90,000 and 95,000, you take whichever is lower. Whichever is lower. So, what do you say? You say it is 90,000. Correct? So, 90,000, what you call the FR, that is your fair rent. 90,000 of fair rent will only be considered as your gross annual value. But let's take between these 3 months, December 21 to March 22, there's December, January, February, March. For 4 months, it was vacant. It was what? Vacant, that is unoccupied. Someone had a question about what do you mean by unoccupied. Unoccupied is a vacant property. There is no one staying in that property. So this is what you're actually calling it as. So this is 90 or 95,000, whichever is lower. Now, if it is actually vacant for 4 months, December, January, February months. So for that 4 months, what is the rental value? Okay, what is the rental value for 4 months? Four months rental. How much is it? 40,000, correct? So it becomes 1,40,000. So your actual rent is equal to AR minus unrealized rental. So your actual rental is 1,20,000 minus your unrealized rent of 40,000. Now you get only 80,000 as this particular thing. So even in that case, 80,000 is less than 90,000. Correct? So accordingly, what are we actually saying? If it's actually vacant, you need to see whether the vacancy is because what you say. Vacancy is because I am just moving out. I don't have any other property in this particular location. I'm just moving out. So this vacant, whatever you're saying, because of that only, if the AR, that is your actual rental, is less than the expected rent, in that case, what do you do is you can fill up the vacancy by claiming a form with the. So you can fill up this if vacancy is actually sorted out. If someone is actually occupying the property, then fine. Otherwise, if it is actually vacant only, if it is vacant for the entire period, we need to adjust the actual rental. So that's the point we are about. So what I have told you now, I have told you if your actual rental after adjusting with vacancy, please understand the term. If your actual rental after adjusting the vacancy, if that is higher than the expected rent, then if that is the only reason for vacancy, if that is the only reason for the being lower, then it is completely fine. So that's what we are actually referring to as actual rental minus unrealized rental. So what do you mean by the term vacancy? If that is the only reason for AR being lesser than the expected rent, AR can be treated as gross annual value. Clear? So that is 23(1)(c). So hope that is pretty clear now. 23(1)(c). What is the next thing that we are talking about? We are talking about a term called self-occupied or unoccupied. So it's basically no one is occupying the property for the whole year. That is what unoccupied. Someone also questioned about this term unoccupied. Unoccupied is basically, it is in my control. I have neither let out nor I am occupying. Please understand the term. It is neither let out nor I am occupying that property. So in that case, it is called unoccupied. So basically self-occupied or unoccupied. In that case, The gross annual value is nil. Why? Why is gross annual value nil? Okay, because what? There is no actual rent. There is no actual rent. The actual rent is zero. So when your actual rent is zero, you need not work out anything in gross annual value. So you can straight away take it as nil because there is no income. There is no income from that property which is being occupied. Correct? So that's why gross annual value nil. But there are some conditions. Some conditions. What are the conditions? The first condition is very important. You can only have two self-occupied properties. Earlier it was only one. Couple of years back it was amended to two self-occupied properties. So what do you mean by two self-occupied properties? Let's say I have a property in Chennai. I have a property in Madurai, my hometown, which is being occupied by my parents. Now, due to job requirement or something, I have moved to Mumbai. There also I have purchased a house. Now, my Mumbai house is occupied by me. My Madurai house is occupied by my parents. Now, both these houses can be treated as self-occupied. So that's the limit. Two self-occupied properties. It could be owned residence or unoccupied also. Applicable to individual HUF. So it is applicable to individual and the HUF. This provision of two self-occupied properties is applicable to the individuals and Hindu undivided family members. The last thing that we need to understand is there is no deduction of MT. What is MT? Municipal tax. So since gross annual value is nil, there is no municipal tax. So your net annual value cannot be negative. Please understand, your net annual value cannot be negative. So why am I using this term? Let's say self-occupied. My gross annual value is zero because I'm self-occupied. Now my municipal tax, let's say I paid 20. Now your net annual value cannot be minus 20. This is not allowed. So that's why we say municipal tax will be zero for self-occupied properties because you cannot claim a negative net annual value. So that's what we are actually calling it as no deduction of municipal taxes. Okay. The next factor, the next category that we are going to discuss is self-occupied let out for part of the year. So for part of the house, it is self-occupied. For part of the house is let out. Now I'll give you an example. I am in Bangalore. In Bengaluru, I have a own house. Now I have been transferred. To Kolkata. So from Bangalore to Kolkata, I moved out. So this house in Bangalore, when I am moving out, I am letting it out and moving. So now for part period self-occupied, for part period it is let out. Correct? For part period it is self-occupied. For part period is let out. What do you do? Now expected rent should be calculated for the whole year. So when you're calculating gross annual value, please remember, expected rent should be for the whole year, not for the period for which it was let out. Expected rent should be for the whole year. And higher of expected rent, which is for the whole year, versus actual rent only for the let out period. Because if you have let out for 6 months, you would have only received rental for 6 months. You should only consider that as actual rent, correct? Because actual rent is equal to actual rent minus unrealized, correct? So that's what we are actually calling it as ER versus AR. So ER will be for the whole year, whereas AR will be only for the short period for which it was actually let out. So of course, which will be higher? Of course, the ER will be higher. So typically for partly self-occupied, partly let out, preferably the ER only will be the gross annual value. And the last point for this particular category is municipal tax. For a whole year is allowed as deduction. Since you are considering expected rent as the whole year, municipal tax is also allowed for the whole year. So MT is also allowed for the whole year. So that's an important point. What are we saying? We are saying if it's partly self-occupied and partly let out, we are trying to say calculate this expected rent for the whole year, calculate expected rent for the whole year, higher of ER versus AR. So higher of expected rent minus versus actual rent. Typically what we did for the other things. So this concept, actual rent, will be considered as the gross annual value. On this, you can reduce municipal tax for whole year. So for the whole year, you can deduct the municipal taxes. So that is self-occupied and let out during the rest of the period. Okay. Now we are coming to a concept called deemed to be let out. Deemed. What do you mean by the word deemed? Deemed is something like assumed. I thought. I am considering it in this manner. So deemed to be let out is an kind of let out. Correct? So kind of let out. So what do they say? When does that happen? When does it happen? When you have more than 2 houses that are self-occupied. Let's say I am married. I have a property in Madurai. I have given it to my parents. I have another property in Madurai that I have given to my in-laws. Now I am moving to out of Madurai for an work in Mumbai, where I am buying a house. I am buying a house. So I am occupying that also. Now, how many houses do I have? 3. How many houses do I have? I have 3. So what are these? Madurai, 1 for in-laws, Madurai, 2 for parents, and Mumbai, 3 self. Now you can only take 2 houses, correct? You can only take 2 houses. So which means the third one or the subsequent ones will be treated as deemed to be let out. So 2 self-occupied in excess of 2 will be considered as self-occupied, will be considered as deemed to be let out. So now there is a beautiful thing in this in income tax, that is basically which one to be self-occupied, which one to be let out is at the discretion of the assessee, and they can change every year also. This year it is second house, next year it is third house. So he can do it on his own, whatever data he wants. So at assessee's discretion can change every year. So that's what I'm trying to tell you. It is not only assessee's discretion, it is like assessee can change it every year. This year it is house 2, next year it is house 3, the year after that is house 1. So all that can happen. So that's what assessee's discretion is about. Now the next one we have to understand is expected rent will be the gross annual value. Expected rent will be the gross annual value because there is no actual rent. There is no actual rent. There is only expected rent. So we need not compare expected rent with actual rent. Expected rent itself will be considered as the gross annual value. Municipal tax can be allowed as deduction. Since it is expected rent, since you have an income, municipal taxes can be claimed. Next one is about stock in trade. We already discussed this. So if stock in trade, the annual value will be nil. But this annual value of nil is only for the first 2 years. First 2 years at the end of the financial year in which it is there. From the third year, we need to calculate the value as if it is what deemed to be let out from the third year. Next one is portion of let out or self-occupied. So what do you mean by that? There is one house, one single floor, it's not an independent house and all, where part of it is self-occupied, part of it is let out. Let's say there are 3 rooms. One room is let out. The other 2 rooms are self-occupied. Now, how do we do that? So we need to treat them as independent units. That one as one unit, this 2 as another unit. So what do you do? If there are 3 rooms in a particular house, where 2 rooms are given to one particular person, the one house is treated as another unit. So what happens? All those 3 are treated as 3 independent units as if they are 3 houses. So that's what you're actually calling the independent units. And everything has been proportionate. The municipal rent, the fair rent, the standard rent, any other taxes. Everything should be in proportionate. Please remember the word proportionate. Since it is what? Since it is portion, part of it is let out, part of it is self-occupied. So that's what you need to do. So these are for independent units where municipal rates, fair rent or standard rent, everything has to be taken in accordance with the other rules. So whatever is already announced here, that applies to here also. The only additional thing that we are trying to understand here is each unit must be treated as independent units. So as I told you, if there are 3-bedroom flat, 2 is given to one person, 1 is given to another person, it will be split in this ratio. So we'll assume 3 rooms, 2 and 1. So this is related to, we'll keep it as Ramesh, Suresh. So this is let out to Ramesh and this is let out to Suresh. Now when you're actually splitting this municipal rent, fair rent or something, you do it 2 by 3, 1 by 3. So if it's actually 12,000, you calculate as 8,000, 4,000. So this is what you do for what? The proportionate municipal rent, fair rent and standard rent. So this has to be done in proportionate basis. So that's what the next category. So we'll move on to the last segment of determination of annual value. The first thing that we are going to talk about is unrealized rent. Unrealized rent has been given in an explanation. So basically what do you mean by unrealized? We already discussed. So it must not be, rental must not be capable of being realized. So you are not able to get the rent, not just today, you are not able to get it, you're not going to get it for quite some time. So what does, it should be a bona fide tenancy. There must actually be a person who's living there, who's a proper tenant, who's now failed to pay. And then you say default tenant vacated, either they have already vacated or reasonable steps are being taken to vacate them. So that's the second condition. What is the third condition? Defaulting tenant not in occupation. Defaulting tenant not in occupation. So which basically of any other property of Asasi. So Asasi owns 4 properties. This particular person who was not defaulted cannot own any other property for during that time. So that's what it is about. So these are strict conditions. And the last condition is step to be taken to institute legal proceedings. So you actually need not file legal proceedings. What the Act says is you must plan in such a manner that you might take a legal proceeding. You're just analyzing the consequence of taking a legal proceeding. So that's what you actually mean by institute the legal proceedings to recover the unpaid rent. So this is one important section under section 23, clause 1. The next one that we are going to discuss about property taxes. We have been talking about this term municipal taxes. What do you mean by the term municipal taxes? It's a tax paid to government for owning this property. So I own this property for that infrastructure development, what they've given to me. I pay them some taxes called municipal taxes. So what do they actually say? Municipal taxes available as deduction. Now we are going to understand when can you claim municipal taxes as deduction. So when can you claim it? We spoke about gross annual value minus municipal tax, correct? So when can you actually claim this? So what is it? Municipal taxes are allowable as deduction if when borne by the assessee. So tenant is not paying, it is actually borne by the owner. Borne by the owner. Actually paid. So now this is allowed on what basis? Payment basis. So this municipal taxes can be claimed as a deduction, can be claimed as an allowance based on actually paid during the previous year. So it is for that year, how much was actually paid. That only we need to consider. Next is deduction allowable in the year of payment by the contractor, by the owner. So basically what was introduced is, there are some provisions in section in PGBP, okay, profit and gains of business operation. So let's take about the section called 40 clause A. Okay, there is this section. This section says, if tax has not been deducted, tax deduction, default, correct? There is a default in tax deduction. So generally the rule is, when there is a default in tax deduction, whatever is the actual bill amount, 30% of that should be disallowed. So deduction allowable in the year of payment by the owner. Property outside India is basically local authority tax are allowable. So where AV is nil, no deduction is allowable. So municipal taxes cannot be claimed when you're annual value is basically nil. So municipal taxes must actually be paid. Municipal taxes must actually be paid. This concept we'll actually understand in PGBP. For time being, we'll leave it out. So basically, it must actually be paid by the previous year. So deduction is allowable in the year of payment. Let's say for previous year 15-16 I paid right now, it is allowed. It is right now allowed. So that's what it is about. So whatever year we are talking about, it is actually allowed. So previous year 2015-16, let's say it is 10,000. Previous year 17-18, let's say it is 12,000. Okay. I have paid it on 31 May 21. 31 May 21. Now this 22,000 can be claimed in previous year 2021-22. 2021-22. So you will actually be claiming it in that particular year, in the year of payment, in the year of payment. So that's what we are actually called municipal taxes are allowed in the previous year. Property outside India. So if the property is outside India, whatever the local authority taxes are allowed. If similar to municipal taxes, there are some local taxes in that particular country. Whatever is that is allowed. But there also it must be paid by the owner. So the only condition is municipal taxes condition is paid by owner. Okay, so it must be paid by owner. So that's the only condition for municipal taxes. And if it is self-occupied, it is nil. So because you don't consider municipal taxes for self-occupied properties. Why did I say your net annual value cannot be negative? Your net annual value cannot be negative. Okay, so that's about this provision. We'll just see few illustrations and then we will proceed. So basically we are trying to say Rajesh, a British national. Okay. Rajesh is basically a British national. He is a resident, ordinary resident. So he is a resident, ordinary resident. Okay. In India during previous year 21-22. He owns a house in London. Okay. He is a resident, ordinary resident. So it doesn't matter whether income is received in India or not. It is still taxable. If in some way, if your income is received in India, if your income is if you're resident in India, irrespective of whether you receive it in India or not, it is taxable. So which he has let out for 10,000 per month. Okay. The municipal taxes paid to Municipal Corporation of London, local authority, is 8,000 during the During the previous year 18-19. So the municipal taxes paid to the Corporation of London is 8,000, but it relates to previous year 18-19. The value of £1 in India rupee to be taken is 95. So the sterling dollar rate is 95. So they want us to compute the net annual value. So we'll actually first calculate what? Gross annual value. So what is gross annual value? There is no fair rent. There is no municipal rent. There is no standard rent. So automatically what happens? You cannot calculate expected rent. When you cannot calculate expected rent, you straight away consider actual rent. So what is the actual rent? 10,000 per month into 95 per currency, correct? 95 per pound sterling into 12. So this will be a rental value, correct? So what will it be? 10,000 into 95 into 12. 1 crore 14 lakhs. 1 crore 14 lakhs. So this will be a gross annual value. Less municipal tax. Well, how much is municipal tax? Municipal tax is paid during the year. It relates to 18-19, but that doesn't matter. It is paid during the year. So it is 8,000 into 95, correct? So 8,000 into 95. What will be the rate? 7,60,000. So your income from house property will be how much? Will be 1 crore 14 lakhs, right? 1 crore 14 lakhs minus 7,60,000. So it will be 1 crore 6,40,000. So this will be your income from house property. Clear? So that is your value. So the point here is municipal taxes can be claimed in the year of payment, even if it relates to a foreign property or whatever. The only point here is if it's a foreign property, it should have been paid to the local authority of that particular jurisdiction. So that's what we are actually talking about. Okay. We'll probably just understand this slide and relevant slides of relevant slides relating to this point and stop today, probably another 10 minutes. But I'll continue this, the same slide, whatever I'm going to take now, I'll again repeat today to just understand the concept of this alone. The 30% is flat, but this interest on borrowed capital alone, I'll explain you right now. I'll anyways repeat it in the next session also. So for time being, we'll just rush through and we'll take it next time. So what are we going to talk about right now? We already discussed about gross annual value. We already discussed about the concept of municipal tax, correct? We already discussed about net annual value is equal to gross annual value minus municipal tax. We discussed how gross annual value has to be computed. We also discussed how net annual value has to be computed in various scenarios: self-occupied, partly self-occupied, vacant, unoccupied, deemed to be let out. All these scenarios we have discussed, correct? Now what we are going to discuss about is the concept of deductions from net annual value. After net annual value, you have a flat deduction of 30%. So this is clause A, section 24, clause A. What about interest on borrowed capital? It is boss B. So your income from house property is after adjusting 30% of net annual value and the interest expenditure on the borrowed capital. So that's what it is about. Now, what about this interest on borrowed capital? I no need to give you explanation on this what? 30% NAV, because straightforward. Whatever is net annual value, you take 30%. So now I have a brilliant question. What will be the deductions from net annual value, the 30% deduction of a self-occupied property? What will it be there? It will be zero. Why? Because your gross annual value must be zero. So you cannot consider municipal tax. So your net annual value is also zero. Since your net annual value is zero, your 30% of net annual value is also zero. Correct? Very simple, right? So for a self-occupied property, till this, it will be nil. Nil for self-occupied. Okay. So it will be nil for till self-occupied property. So that's what it is about. So now the purpose of loan. So we are now getting into the concept of interest on borrowed capital. Please understand. I'll just rush through right now for the next couple of minutes, and probably I'll repeat this to understand in the next class also. The purpose of loan can be for acquisition, can be for construction, can be for repair, renewal, reconstruction, or transfer of loan from one bank to another loan. That is repay of original loan. So these are all the causes for which a loan could be purchased. Loan could be taken. Now, how do I remember all these terms? The purpose of loan. You need not remember. I'll tell you a scenario. I am buying a property. Okay. I am taking loan for buying a property. It is allowed. I am taking a loan for constructing a property. It is allowed. Okay. I am taking for buying a property, for constructing a property. Now I already have a property. Okay. I'll just explain you itself. Now, in 1st April 2016, I purchased individual house. Okay, individual house. We need not bother about the amount. So for this, I have taken a loan. So this is acquiring. Now, in 1st April 2018, I am constructing one floor. So this is only ground floor. Now GF stands for ground floor, nothing other than that. So now GF is ground floor. Up from here, I'm building a first floor. So constructing. constructing is first floor. I'm constructing first floor. For this also, I'm taking loan. So this becomes construction. Okay. Then in 1st October 2020, there are lots of the property is damaged due to a flood and all. Okay, there is a flood. So due to a flood, the property is damaged. So I'm repairing. Okay. So I'm repairing this property. So this for this also I'm taking a loan. Okay. For this also I'm taking a loan. So this is also allowed. So this is what is called repair. So the damage is called repair. So that's what we are calling it as. So all this acquisition, construction, repair is about the property. Now I already have a loan. I am renewing. I already have a loan. I am transferring it from one bank to another. So all this is about relating to loan. This repay, original loan, renewal and all is relating to the loan amount. So for all these reasons, you are allowed to take a loan. So the relevant year for the loan is year of completion. Interest can be claimed only from the year of completion. Interest can be claimed only from the year of completion. So before completion, if you are paying interest. Now let's take another example. 1st October 2020 or 20, let it be there. So I buy a land. Okay, I buy a land. Now I've started constructing. 1st November 2020, start construction. Okay. I've got a loan here. Okay. I've got a loan here. I have a loan here. Now I am paying interest. This property got completed on 30th September 2022. Okay. Completion. Now, this period, that is interest from 1st October 2020 to 30th September 2022 is called pre-construction. From 1st October 2022 is your regular interest. Okay. So income tax says if it is a pre-construction, if it is relating to a pre-construction period, income tax says whatever is this pre-construction period, you have a method of computation. We'll discuss that in next class. You obviously will be very tired. Your dinner could be waiting for you. All that is there, right? So the ideology of this particular slide, what I wanted to tell and conclude is the loan is not just straight away deductible. There are conditions. So the first condition that we are seeing today is relating to the year of completion and construction period. So that's what we are trying about. So we'll understand how do you treat with this interest. Similarly, about self-occupied, about let out. So the conditions vary. So the interest condition for interest, conditions are based on the construction period. Okay. Construction period, self-occupied, let out. Okay. For all these things, it changes. The provision, how to, the treatment of this interest on loan changes based on each of these. So that's what it is about. So with this, probably we'll conclude today. We'll conclude it today. And in the next session on 8th, we will continue with the rest of this house property. So that's what we wanted to understand in this particular session. So before just winding up, if there's any short questions, I'll answer it. Amrit Pal, what if vacancy is filled during this 4 months? See, whatever is actually the vacancy only, we need to take it. If the vacancy is only for 2 months, for the other 2 months it was occupied, vacancy is only for 2 months. So the real vacancy only should be considered for the calculation of this actual rental value. All assessees eligible for 23(1) ABC and section 23 for remaining 23(2) and 3(4) is what is. See, whatever we discuss, that is 23(1) ABC and all, is about your unrealized rental and your self-occupied and other things. But when we are talking about this 23(5), we are talking about the issue of stock in trade, right? So the section 23 clause 5 is about stock in trade, where stock in trade can be a company also. So it can be company or individuals. But when you're talking about this 23(1) ABC, that is whatever we are discussing about 23(1) ABC, where we are talking about vacant or something about self-occupied and all. If you actually see throughout let out throughout the year, vacant throughout the year, for all these things, it can be a company also. But the only provisions where we are talking about certain things like your what you call self-occupied, it can be only individual or HUF. Similarly, relating to your deemed to be let out is also individual HUF. So whatever you have said, Mansha, is correct. So to summarize, the self-occupied property and deemed to be let out, the provisions are applicable only for individual or HUF, whereas the provisions of vacancy or this stock in trade is applicable to everyone, is for any kind of person. Any way to remember this municipal rent? I guess we'll have to remember it like step 1, step 2 only. Municipal rent or fair rent, whichever is higher. Then on that, you compare with standard rent, whichever is lower. Then you compare with actual rent, whichever is higher. So it's like as I told you, two-factor authentication. So you find these two factors to find out the expected rent and then compare with actual rent. Mukta Vyas, flat deduction is allowed on what? I don't understand on what you are talking about. If it is related to 30% deduction, there are two types of deductions we are talking about. One is net annual value. This is a flat deduction. It's flat 30%. The other one we are talking is not a flat deduction. It is interest. So the 30% deduction is a flat deduction, whereas interest on borrowed capital is not a flat deduction. So with that, we'll wind up. So in the next class, we'll complete this house property. Since there is too much to cover in the next class also, that's why I'm just extending a little bit so that I wanted to give some extra inputs. So 15-20 minutes extra is what I'm actually trying to do. I know I'm putting you in a difficult situation, but it is always for your good. So thank you for your time. We'll see you in the next session. Thanks a lot. Yeah, concluded.